we will, a little bit ahead of time as it happens, move to our first panel. I am reminded of one instruction that I forgot to give, and that is we would ask everyone to turn off cell phones so that we don't have interruptions during the course of the comments or questions. So we'll now move to our first panel. We'll be hearing from Gail Hillebrand of Consumers Union, Joe Rideout of Consumer Action, Kerwin Tesdell of the Community Development Venture Capital Alliance, Tanya Fiddler of the Native Community Development Financial Institution Network, and Mark Willis of New York University. Ms. Hillebrand, please begin.
Thank you. I'm Gail Hillebrand, Financial Services Campaign Manager of Consumers Union. You know us as the nonprofit publisher of Consumer Reports. Our mission is to test, inform, and protect, and I'm with the Protect piece. It's been my privilege to work on Community Reinvestment Act issues here in California since 1986. And as we talk about regulatory improvements today, I want to encourage you to take this opportunity to enhance and fulfill the promise of CRA, that no one gets left behind in the U.S. financial system because of lack of access to capital or banking services. As a consumer advocate, I have a deep interest in CRA because we spend way too much time in the consumer movement trying to stop bad practices, one at a time. And CRA gives us an opportunity, working with community groups and with banks, to create good products and good alternatives in the marketplace. Everything you do to change this regulation, I want to be focused on that question of encouraging banks and communities to work together to identify not only needs in the low-income communities, individuals, families, and people who serve them, but also opportunities for banks to turn that into their mainline business and mainstream business. There are viable business opportunities in low-income America, and part of CRA is to nudge banks, might be the original nudge economics, to find them. The CRA issue today is not access to credit and services, it's access to quality and safe credit and services. There is unfortunately plenty of access for low-income consumers to what are politely called alternative services, generally at a higher cost and with fewer protections. So as you look particularly at the consumer products, we want you to be looking at whether those products have fair terms, price transparency, and are sustainable. Loans are underwritten and repayable and fully amortizing. And to be encouraging financial institutions to work with communities to create products that enhance and not detract from financial stability. You haven't done your job if CRA can be satisfied as a regulatory checkbox, or as a bean counting game, or as by writing a check and saying, you know, we paid. I'd like to describe what I think ought to be the 3 stages in a CRA process that the ratings need to honor, evaluate, and support. The first one you might call the innovative and flexible stage. I call it the negotiation stage. This is where bankers and community groups really get in a room and bang their heads together and try to understand not only the needs of the community but the limitations of the bank and how to bring those 2 pieces together into a product that the bank will eventually actually want to take to scale and will be able to take to scale. We can't learn from each other if CRA can be satisfied without those meetings, without those productive discussions, and without products that actually get put on the street at the end. So that's the first stage, head-banging stage. The second stage is when the bank really takes that product into the business side of the bank and treats it the same way they would any other product, markets it, incents the salespeople, and really makes it part of their regular product suite. And the third stage, you don't have to give any CRA credit to. That's when it becomes a mainstream product and when other banks want to offer it too. I'd like to mention several of the specific topics in your questions. Consumers Union does support a broader notion of assessment areas. We recommend that all geographies where the bank gets deposit or credit business or is seeking that business be included in the assessment area. We think that the tie to physical location is simply out of date. We think it's time to end the choice by the bank about whether or not affiliates' activities count. We think that if you are looking at the impact of a financial institution on low and moderate income America, you have to look at the positives and the negatives for the affiliates, the subsidiaries, the joint ventures, whatever the business is called, it still has that same impact on communities. And we want you to look at the affiliates the same way you're looking at the banks. We want you to look at whether they're putting products on the streets that are needed, wanted, and used by low and moderate income communities, whether the products are fair and sustainable, the loans are underwritten, lending patterns are fair, and consumer protection is honored. I'm going to close on a personal note. I almost never do that. It was once, my father once said about my mother, that here's a woman who could squeeze a nickel until she turned it into 2 dimes. There's a lot of talent in low and moderate income America to take that nickel of capital and turn it into 2 dimes for our families, for our communities. It involves hard work and sacrifice, dedication and smart use of resources, but the nickel has to come from somewhere. In my family, it came from a fully amortizing fixed-rate VA loan, but for many families today, it's going to come from a CRA home loan, a safe deposit product that allows building savings instead of bank fees, a fixed low rent because a community development agency or nonprofit has built safe, affordable housing, or a small business loan. And the work you do to modernize CRA will bring that to fruition. Thank you.
Thank you. Mr. Rideout.
Good morning. My name is Joe Rideout. I'm with Consumer Action. Consumer Action is a consumer education and advocacy nonprofit which has been fighting for the rights of consumers since 1971. We offer free publications on topics such as housing, foreclosure, and consumer credit in up to 8 different languages and count over 1,500 community-based organizations in our network of housing group CBOs. And we appreciate the opportunity to participate in this discussion. The CRA must keep pace with changes in the banking and lending world in order to ensure that the needs of low and moderate income communities are met. We must expand CRA assessment to better reflect the ways in which banking and credit have evolved in recent years. As new kinds of financial institutions like online banks have grown in importance, the CRA's ability to require banks to serve the financial needs of low-income Americans has diminished. Therefore, the model of using bank branches for assessment, as Gail has mentioned, must be expanded to include all the communities in which the bank actually does business. As an example, Green Dot, which is a vendor of prepaid or stored value cards, is currently attempting to purchase Bonneville Bank, a financial institution with only 1 branch in Provo, Utah. If Green Dot's acquisition goes smoothly, it's expected to focus the bank on issuing its reloadable prepaid cards and benefit from improving Green Dot's margins through reduced interchange fees. This repurposed bank would issue prepaid cards all over the country, yet given the current methodology of assessment, it would only be responsible for reinvestment in Utah County. Utah County has only 530,000 people, yet people all over the country would be touched by the activities of the bank. Given the transformation of banking, which is less reliance on brick-and-mortar branches and more activities conducted online, it's reasonable to encourage banks to invest wherever they derive a significant portion of their business. Assessment areas should be refined to include any state or area in which the institution has a visible share of the market for loans or other CRA-eligible financial instruments. In order to best achieve the goals for which it was designed, CRA must also evolve to cover a wider range of financial activities that more accurately represent the credit ecosystem of a community. Future iterations of CRA should cover independent mortgage companies, as well as other key credit actors. We should recognize that securities firms like Charles Schwab and Goldman Sachs, insurers, as well as credit unions are also vital to the financial well-being of a community. If CRA had covered independent mortgage companies, most of the deceptive or unsound lending practices would have been prevented. Financial scams run by companies like Ameriquest, New Century, and Countrywide would have been exposed and halted before they could have ensnared so many borrowers. An expansion of CRA would be a simple yet powerful way to shield borrowers from dangerous lending practices. According to the Federal Reserve, just 6% of the sketchiest loans originated in 2005 and 2006 that drove the foreclosure meltdown were made by CRA-regulated institutions. Furthermore, another study by the Federal Reserve Bank of San Francisco found that loans originated by independent mortgage companies not covered by the CRA were twice as likely to go into foreclosure as loans originated by CRA-covered banks in their assessment areas. In terms of CRA examinations, banks should receive CRA credit for their initiatives in foreclosure prevention, which is surely the most urgent housing issue of the present. A bank's efforts at modifying troubled but salvageable mortgages is an appropriate component of how we should measure that institution's success at meeting the needs of the communities it serves. Let's say, for example, a bank developed a new balance forgiveness program. This program, say, would offer borrowers a full principal write-down with a trade-off that upon future sale, the bank would be entitled to 3/4 of the property's appreciation. If such a program was successful in creating sustainable modifications, that bank should receive substantial CRA credit for meeting the needs of that community. Banks which service loans but did not originate them should receive CRA credit for modifications as well, whether or not the modified mortgage fell within the servicer's designated assessment area. Through our consumer hotline, we at Consumer Action hear frequently from homeowners and former homeowners who are bearing the brunt of the foreclosure crisis. A woman from San Pedro, California, for example, explained to Consumer Action a familiar story of how difficult it can be, difficult some servicers can make it just to apply for a mortgage modification. This is her words. We have sent the same paperwork at their request over and over again. It is very difficult to speak to a customer service representative as the recorded message is set to loop and not connect you with a real person. Their customer service for the home retention program is outsourced to India, and I have to leave a message. We have never got a return call or email. We have emailed and written them several requests for a call or email back to no avail. We get a letter sent certified mail every month telling us we are in default of our loan and that we should think about a modification. I don't understand why the company that is supposed to be handling our modification is sending us that kind of letter. We feel a bank's efforts at, or lack thereof, I should say, at foreclosure prevention must be included in that bank's CRA evaluations. We are excited to participate in helping CRA continue to serve our communities and appreciate the opportunity to share with you our comments.
Thank you. Mr. Tesdell?
Yes, my name is Kerwin Tesdell, and I'm the president of the Community Development Venture Capital Alliance, which is the association of venture capital funds in this nation that provide equity capital for small businesses in low-income communities to create good jobs for low-income people and entrepreneurial capacity and wealth that benefit low-income communities. About 40% of the capital in our industry comes from CRA-regulated banks, so obviously CRA is very important to us. And in particular, I'd like to focus my remarks on the investment test of CRA and make 4 particular points. First of all, I'm concerned that CRA has become overly focused on quantitative measures as opposed to qualitative measures. In the investment test, there are 4 factors. There's how many dollars go into deals, but there are also some important qualitative factors that I think create the context and the lens through which you should be viewing the dollars that are going into investments. Are these products routinely available from private investors? Are they responsive to the actual needs of communities? And finally, to the extent that you have an investment that is highly responsive, that is not routinely provided by the private markets, is the bank going the extra mile and making an extra effort to produce this product through innovativeness and complexity to make this an important source of capital available to communities? So I would suggest, rather than starting with counting up dollars, that you focus on these more qualitative issues, and that in each case the dollars be viewed and valued through this lens. Now, obviously, this is harder to do than counting up dollars, but I think you folks are tremendously well positioned to undertake this type of inquiry. You have terrific research and analytical ability to understand the broad capital markets of this country, and I would request that you train that ability on the low-income capital markets and really work with us to think about how the capital markets can work more effectively for low-income communities, not just the citizens of our nation that have more economic resources. Second point is CRA needs to be more focused on producing long-term patient capital for low-income communities. We hear over and over again that is what community developers need, not shorter-term loans. The Q&A says that long-term and short-term investments should be treated equally, but from what I hear from bank CRA officers, often when the examiner actually comes in to do the exam, naturally the examiner is looking for new things, not the investment that was made 8-10 years ago. You know, you don't want the bank to rest on its laurels. But that kind of view actually discourages what's really needed, which is the long-term patient capital for low-income communities. Third point is on the investment test. Right now, CRA is focused more on the form of the capital that's exiting the bank as compared with the form of the capital that's actually being used by the end user of the community. So, for example, the purchase of a mortgage-backed security is credited as an investment by the bank. In fact, I think if you look at the impact on the community, this is really a loan. It may be bundled loans, but it's lending in the low-income community. And I would urge you to re-examine the CRA regulations and look at ways to encourage the availability of what's really needed, which is risk investment capital. And finally, I wanted to note the issue that my colleagues here have noted, which is the reexamination of investment areas. I'll speak specifically to our issue as community development venture capital funds, which are pooled investment funds. So we are not able in advance to identify that we're going to invest in exactly these businesses in exactly these areas. And the problem comes when the CRA assessment area of the bank does not exactly overlap the assessment area, the market area of the fund. And what happens is the fund, tries to do some kind of side letter that says, we'll take your capital and we'll put it in this area rather than that area. You do that with several banks, and you've got this patchwork of requirements, and for the next 10 years you're trying to worry about whether you've got exactly the right dollars in exactly the right places instead of running your fund effectively. So I would suggest that if there is significant overlap between the market area of the fund and the assessment area of the bank, that the inquiry end there. And finally, along the same lines, that if a fund is a certified CDFI, that just as with minority-owned banks and low-income credit unions, that an investment in a CDFI be accorded full CRA credit no matter where that investment may exist. Thank you.
Thank you. Ms. Fiddler.
Good morning. My name is Tanya Fiddler. I'm an enrolled member of the Cheyenne River Sioux Tribe. I've served as Executive Director of Four Bounds Community Fund, a nationally recognized Native CDFI located in Eagle Butte, South Dakota for the past 10 years. I also serve at the national level as a founding co-chair of the Native CDFI Network and have been involved with National Rural Assembly, which is a movement of people and organizations devoted to building a stronger, more vibrant rural America, and it's the support of the Rural Assembly that's made my presence today here possible. I want to say thank you for the opportunity to appear before you on behalf of Four Bounds, the Native CDFI Network, and Native communities. I also testified today as a passionate advocate for the effectiveness of Native CDFIs, connecting Native people to financial services they so desperately need. These institutions are critical partners for the agencies to engage in when assessing bank services as part of our CRA exams. I also testify as a longtime resident of Cheyenne River Sioux Reservation. The issues you are considering are not theoretical to me or the communities I serve. These are matters of financial life and death. Dewey and Ziebach counties are the counties we serve, and they're two of the poorest counties in the country. When we started Four Bounds, 80% of the reservation population was Native American, but less than 1% of the businesses were Native-owned. So while our products and services have clearly enhanced the skills of Native clients over the past decade, there are still significant barriers to working with banks to revitalize our communities. While these realities provide a clear rationale for why I sit here today, in another respect, I don't belong here. In many Native communities, we are worlds away from the conversations going on at these hearings. The Native American Lending Study, which is the most comprehensive study of lending needs in Native communities, was conducted more than 10 years ago and didn't even mention CRA. It identified an unmet capital need in Native communities of $44 billion. It also underscored the fact that Native people aren't thinking about the quality of bank service so much as whether banks serve our communities at all. 86% of Native communities lack access to a single financial institution, and 15% of our community members need to travel over 100 miles to access financial institutions. So with those challenges in mind, I have 10 recommendations, and I'll go through them very quickly. The agencies should develop specific strategies for ongoing engagement with Native communities in order to ensure CRA effectively promotes financial services. Given the unique challenges of Native communities, we urge agencies to carefully review the written testimony given to you throughout this period from Native communities. I know that leading national organizations like the National Congress of American Indians and the Native CDFI Network would be pleased to help facilitate more conversation. Number 2, enhance small business data to include race and gender of the borrower, census tract data on community development lending and investing, and bank deposit and consumer lending. On the question of revising small business and consumer lending data, the answer from Indian country is simple. We need it. You need to collect it. The HMDA data has been used effectively to increase responsible lending by holding banks publicly accountable We need a comparable small business, community development, and consumer lending data set to bolster affordable bank lending and basic services. Number 3, collect pricing information on lending products. You'd be surprised at what we pay out in mainstream or on our reservation communities for bank loans, but for both small business and consumer loans. Number 4, develop tools that make the data more accessible. Recommendation number 5 is to use the data to hold banks accountable. In mid-1995, when the discrimination review became lighter, we actually were having some success in Indian country, having some of the bank performance move up into the justice system. It's not that discrimination doesn't exist anymore, it's just that it's not really looked for like it was before. So that should be considered. Number 6, engage community-based organizations. I heard that mentioned earlier. Our perspective from Indian country is that it's essential for agencies to find more effective methods for facilitating engagement between banks and community-based organizations. We have one bank whose lawyers refuse to help us open individual development accounts because they're unclear of the CRA, that they're CRA eligible activities. So the real world effect of this is our clients are forced to travel an additional 20 miles to get to a bank. Banks in my community are also not held accountable to offer products that meet the needs of our customers. Absence of competition means interest rates above 20% are not uncommon for loan products. Recommendation number 7, recognize innovative practices. Number 8, impose meaningful consequences for noncompliance. We have a bank located in another reservation in South Dakota that's had needs to improve grades since 1996 and have had no changes since then. So I think it's important that there should be some consequences for noncompliance. Recommendation number 9, add a specific community development test for large banks and remove exemptions for small and intermediate banks. It's well known in our res communities that we fly under the CRA radar and banks don't necessarily have to perform. They tell us that it's just out of the goodness of their hearts that they deal with us at all. Last one, include long-term unemployment as a criteria for accessing distressed communities. Thank you.
Thank you. And Mr. Willis.
Good morning. Thank you for inviting me to share with you today my thoughts on ways to make the CRA more effective in helping to stabilize and revitalize low and moderate income communities. I'm a resident research fellow at the Furman Center for Real Estate and Urban Policy at NYU. I speak today solely in my personal capacity and based on my years of experience as head of community development for J.P. Morgan Chase and as a researcher and urban economist. I commend you for holding these hearings. The CRA can benefit greatly from changes that are within your power to make. My submitted written testimony outlines a number of options, including balancing qualitative and quantitative measures, establishing a community development test for large retail banks, creating a safety valve to guard against any risks to safety and soundness and unnecessary duplication of the efforts of others, increasing responsiveness to variations in local needs, and ensuring that all communities can benefit from the CRA. CRA is an exceptional legislation because, at its core, it establishes an affirmative obligation rather than a prohibition on certain behavior or actions. However, an affirmative obligation also presents certain challenges. It requires continual adaptation to changes in markets, industry structure, and community development best practices. Examination procedures also need to be adjusted regularly as lessons are learned as to which tests are working well and which are not. The CRA has many stakeholders with widely varying perspectives. You are no doubt hearing a broad range of opinions, not all of which seem reconcilable, at least on the surface, thus making your job particularly difficult. So I want to suggest that you consider, in addition to hearings, encouraging forums to convene diverse groups of stakeholders specifically for the purpose of exploring possible common ground. Last year, in my role as a visiting scholar at the Ford Foundation, I twice convened a small group encompassing a cross-section of stakeholders, offering a forum to allow the participants to get to know and better understand each other and each other's perspectives. The reactions were very positive, and I believe these sessions have already borne fruit in opening up new lines of communication between the parties and in helping to build consensus. Let me now use my limited time to say a few words about the two topics which are the principal focus of this hearing. With regard to data for small business and consumer lending, the first question should be, what type and quality of data are needed for your examiners to be able to assess impact in low and moderate income communities without imposing unreasonable data collection costs on banks? This is not a simpler question as it may seem initially, since it begs the question as to what should be the scope of the exams. In that regard, I suggest caution in trying to do too much through CRA. The challenges faced by LMI communities cannot be solved by a single regulation, exam procedures, or a limited group of institutions. A separate question is, how much of the data should be made public? The answer requires finding the right balance between the benefits of public disclosure and bankers' concerns about borrower privacy, proprietary information, etc. CRA has and should continue to benefit from public participation in monitoring banks' performance and highlighting issues for more regulatory scrutiny, especially given the likely decrease in the number of public meetings triggered by CRA-related mergers and acquisitions. It is critical that the public have at least enough information to be able to shift the burden of proof to the banks or to the examiners when the data suggests areas of concerns. I also recommend that you hold annual forums to review the new data as it is released. With regard to performance evaluations, a major problem is that these publications lag far behind the time period they cover. For banks, this delay limits their ability to adjust their CRA business plans until well into the next exam period. For the community, the information is so dated that it can be of only limited use for identifying any issues with the current or future performance of the bank. New exam protocols are needed to facilitate faster exams, at least for the larger banks, and more timely release of the results. Let me end with a note on the need not just to update the CRA regulations, but to institute a process to keep them current. I believe the more regular updating is not only essential for regulation based on an environmental obligation, but also makes change easier by allowing for smaller steps, more rapid mid-course corrections, and for time to promote efforts for the stakeholders to find common ground. Stakeholders rarely find themselves in a meaningful dialogue with each other, even when they appear at the same hearing or participate on the same conference panel. I again urge you to promote modest-sized forums which allow all the participants to speak and be heard, and have proven to be successful in improving communication and building consensus on critical issues and potential changes to CRA regulation. I'd be happy to answer any questions you may have, and again, thank you for the opportunity to be part of this process.
Well, thank you very much. Thank you all. Our timekeeper is falling asleep there because everyone's been so disciplined in staying within their 5-minute allotment. You've obviously testified before, I think. We'll now have 10 minutes of questions from each of the agency representatives, and I would ask John to begin.
Thank you, John. And I hope Herschel stays asleep when I ask my questions, because I have lots of them. First of all, I'd like to thank you all for your compliments regarding the regulator's ability to work through some of these issues. And I would tell you that your confidence and your compliments are respected but are not always well placed, which is why we have hearings like this. But I'd like to turn it back on to your side of the table. In a number of these hearings that we have participated in, the discussion of assessment areas and the outdated nature of that concept continues to come up. As many panelists have tried to probe further with those people raising the question, we don't get a lot of bite. People sort of step up and they step back. This is your chance. This is your chance to sort of step up there and give us some of your ideas in terms of what we do with the assessment area, what are the kinds of things might be acceptable or more challenging, first for the institutions we regulate, but more importantly for the communities and the areas that might receive service. Ms. Fiddler talked about Native American communities. We've had other participants talk about various natural disasters, Katrina being the most obvious example where the regulators have provided credit for certain services and loans. We've had participants from rural areas who talk about some of the challenges that they face versus urban communities. And we have people from urban communities talk about the competition that is engaged in by many, many institutions or services or providing services in those communities and some of the risk that results from doing that. Mr. Tesdell, why don't I start with you, and I'll ask all the panelists, realizing we've got 10 minutes and Herschel will throw things at us if you go too much longer. So some ideas. Sure. Concrete ideas.
Yeah, I'd suggest that rather than think in terms exclusively of where banks take deposit, take a practical, common sense business view of what it makes sense to be asking a bank to do. So, for example, if you have a local bank in Oklahoma, it doesn't make sense for that bank to go national, invest in a CDC in New York City, that bank should be investing locally in the community that it knows and where it has the capacity to serve. On the other hand, if you have a Citibank or a Goldman Sachs, that bank, I think, should be charged with looking nationally and thinking innovatively about how it can serve the broader credit and capital needs of this nation. And in fact, I think a national bank such as those should be focusing more of their resources on very low-income communities. One unfortunate result of the current assessment area system is that capital is actually driven into more economically active areas. So I'll use an example from before the crash, but our funds in Florida or California found it relatively easy to raise capital as compared with a fund in Appalachia or the Delta region of Mississippi. The reverse should be true, at least with respect to those national level and regional level banks. And in addition, I think not only in terms of geography, but also in terms of product. I think it would be a real waste if with Goldman Sachs and Morgan Stanley sort of joining the fold here, if the regulators were sort of push them into the same kinds of activity that an average bank would undertake. Push Goldman Sachs and push Morgan Stanley to use their capacities, use the things that they do best to serve the capital markets in low-income communities. And I'll just make one final point since you mentioned the disaster areas. I guess I just caution using CRA to address every problem that occurs in our nation. I think CRA should be focused on its core responsibility, which is low-income people and low-income communities, and not to sort of answer every problem that comes up, although certainly a national disaster like Katrina was tied in that case to economic issues.
Would you treat, you mentioned large national banks. How about the community bank that wants to take advantage of or look beyond its immediate assessment area to provide services or products?
Sure. I think to the extent that it is interested in doing that, to the extent that it has the capacity to do that in an intelligent way, I think that makes a lot of sense. On the other hand, to take the example of the Oklahoma Bank, I think to the extent that, what's happening is it's sort of getting into the syndicate of everyone's investing in this fund off in New York City, and it's relatively easy to do, and it's set up by somebody else. I don't know that that's the role that the local Oklahoma Bank should be playing. I think the local Oklahoma Bank should be serving the needs of its community that it knows the best.
Good. Ms. Fiddler, would you like to?
Conversation on assessment area is hard because I come from rural and frontier rural to that extent. So I would recommend convening the rural bankers. There's reasons, I understand, in the markets that they're working within. Our local community-owned banks do fairly well and would do a lot better in their assessments or their CRA reviews if you could consider the community development activities, that kind of thing. We have another bank that has a product that is credit cards, so when they go to test in, their assessment area is the large national, but they're performing on the local. I think you need to talk to the bankers, the rural community bankers, to understand, because they're challenging markets to work within, period, and meet everybody's needs, hence the high pricing and the lack of access and all the other stuff. So I don't, assessment areas are just out of my league to think of it that way.
Okay, all right. Mr. Willis.
Yes, thank you. I think part of the problem that you're probably facing here is these discussions are you should expand them or not expand them in some broad sense. And I think it's really important to think about it in a nuanced way, and Kerwin gave some thoughts on that. So, for example, internet banks or ILCs that have a limited number of headquarters, limited deposit taking maybe only in the headquarters city, I think we need to rethink whether that's the assessment area they should be involved in. And I think you should also think about whether strategic plans is something that could be more appropriate for that situation. With regard to large national banks that have lots of branches, the idea that they get credit for investing in a national or regional fund only if it, to the extent it's in their specific assessment areas, doesn't make a lot of sense from an economic point of view or whatever. But it does raise the issue of mandatory versus voluntary. And so I think in the case of those banks, you may want to consider allowing full credit for investing in national funds that may not be in their assessment areas, but not mandating. And the reason not to mandate here is, again, how many assessment areas can an examiner look at in a serious way? And if we're talking about looking at more qualitative issues than just quantitative, expanding the doubling, tripling, I don't even know what the numbers are, but large expansion of the number of assessment areas will probably hurt the quality of, or the ability of the examiners to do a quality exam, to look at qualitative factors there. And the exams will get even longer, which I think is also something that you don't want to have. One of the concerns people have is that some communities are underserved, so that you have where national banks are serving local community, the local banks are small, they're subject to a small bank test, that whole set of issues. I think you should seriously give consideration that maybe banks should get extra credit for serving those communities. You can identify, I think, which communities are truly underserved and provide some mechanism here by which they get. The larger banks or regional banks could get credit for investing in what could be identified as CRA underserved communities.
So you'd have the regulator identify an underserved area and then sort of allow all comers to fill in those gaps?
Right. I use the word CRA underserved.
Okay.
Right, because you have identified in general what you view as underserved, or the regulation does.
Sure.
So just what areas maybe aren't getting addressed because they're just small banks there, and partly the reason those are small banks is because national banks are offering products there but not taking deposits, for example.
Good. Thank you. Ms. Hillebrand.
Yes, thank you. I think this is a question that calls for some balance and nuance. It is difficult because we don't want to say, you're a national bank, the whole country is your assessment area, and if you did something in New Jersey, you're done. You know, you had the numbers and you did it in one place. Clearly that undermines the very idea of getting banks to open their eyes to the opportunities that exist in all of our low and moderate income communities. But if we think about, I think maybe the reason that deposits were chosen in the first place is deposits and lending used to match up.
Right. Right.
And so if we think about it that way, we think about what's the bank's core business. If their core business is deposits and lending, or deposits or lending, then we ought to be covering both of those things when we look at their assessment areas. And it's important in doing that not to look at whether the particular geographic area is significant in terms of the bank's volume, because there'd be a lot of communities where there's very significant volume to the community but not to the bank, but instead whether it is an active participant in a marketplace in a local geography. So if we look at that, I think that might give us something closer to, large regions are probably going to have to cover their whole region. Large national banks that cover, 5 out of 6 regions in the country are probably going to have to cover those 5. But it becomes even more important as assessment areas get bigger for you to be, as regulators, providing some really quantitative and qualitative information and signals to the banks that you really have to serve the whole community, not just we serve some low-income people and some moderate-income people in some of our areas, and I think that's the challenge. And one thing we did ask you for in our written comments was to provide transparent information so that not only you and your examiners can evaluate how banks are doing, but the public, the media, institutional depositors, institutional investors. Consumers call me up and say, who has a good record, who should I bank with? It's very hard to answer that question on the publicly available information unless you do a huge amount of homework, and even then. So in addition to what you do to modernize the regulation, we'd like to see the bank regulators put up a searchable online database of the information that you have about who's performing how, so people can draw their own conclusions and bring to your attention, we don't think this bank is doing the job in our area.
Good. Mr. Ryder, I think my time has expired, but hopefully we'll have a second round.
Okay, fair enough.
Okay? Oh, go ahead. All right.
I'll be brief then. I echo a lot of the sentiments that were expressed earlier. I guess this is an example of how the tools that CRA has were a lot more powerful in 1977 than they are today. Not only did they not anticipate some of the problems that we're experiencing in the present, in 1977 they didn't even anticipate Smiley versus Citibank, which upended our conception of what it means for a bank to be chartered in a given location. There's a lot of things that have changed, and I think when you're looking at how to modify an assessment area, you can look at wherever a bank derives a significant portion of its business, or if it captures a certain percentage, even be it 1 or 2% of a credit market for CRA-regulated financial instruments, that should, with a reasonable degree of flexibility, be included in how that bank is assessed.
The only difficulty I have with that goes to Ms. Fiddler's points, where business doesn't always track exactly the CRA needs, and whether or not there's an opportunity here for banks to fill that need in a way that works from sort of a quantitative, qualitative way. So
I agree. I mean, but that flexibility should include, proactive incentives that'll help communities and at the same time shield communities from being underserved.
thank you.
Thank you. I'd like the panel to explore the role of innovative consumer lending products, such as small dollar lending, and how we treat it under the CRA. Specifically, should there be some type of retail services test or a community development test that incorporates the extent to which institutions provide or develop innovative products? And is there a role for the banking agencies in terms of identifying what the range or scope of those quality products should be? And the flip side of that is if an institution does not offer those products, but I think Ms. Hillebrand used the term engaged in adverse activities, how should we take that into account in terms of ratings, whether it should be a negative impact, or to what extent should we be looking to develop incentives to have institutions develop safe, quality products, which I believe you used. If you don't mind starting, Ms. Hillebrand, I'd appreciate it.
Thank you. Of course, we were very pleased to see the FDIC Safe Deposit Account template, which was released quite recently. I think that there is room, and it's appropriate to give banks credit for moving forward in pioneering and then really marketing up to scale and putting on the street products that are safer. I mean, we shouldn't be having this conversation, right? We shouldn't have to have a federal district court tell us just this month that a major California, not so California-based bank gamed the system and changed the rules so that it would cost more for people to hold deposit accounts with them if they had low balances. But that's the world we live in. So ideally, community groups will be coming to banks describing what a safe product is. We've been doing that for 20 years. And if it takes the regulators to describe what it is in a way that gets banks' attention, then we're happy to have the FDIC do that. I think there ought to be credit for those. I think it's a closer question whether there should be a negative for not stepping up in one particular area if a bank is stepping up in other areas. If they're making the small business loans and they're making the deed-restricted community development loans, but they're not doing the consumer piece. But definitely should be a plus if they are doing it, and if they're actually engaged in activities that are adverse, that drive the low-balance customer out of the bank, that's a different question. No one should be getting an outstanding CRA rating who's engaged in those kinds of practices.
Thank you. Mr. Rideout?
We also would think that there should be a place for that in the overall composition of how you evaluate banks. I guess the danger is that some of the what we'd call innovations in small dollar lending haven't necessarily been to the benefit of consumers. And when you see, for example, payday lending and quasi-payday lending being offered even by large financial institutions that can charge 120% interest, some of these innovations aren't necessarily going to benefit consumers, but we feel that that that's at the same time a great way to help consumers if it's done right. I mean, you can see in California here, there are a number of initiatives like Bank on San Francisco, Bank on California, Bank on Los Angeles, where they're trying to get small depositors into the financial mainstream and are doing it effectively. And I think banks that step up and offer something like that internally should be rewarded.
Thank you. Do you see in that particular area the problem that you've identified that there is a role for the banking agencies and the community groups in consultation with them to develop standards, overall standards for products so you can differentiate between what might meet a credit need but is done in a more advantageous fashion?
I think that's an excellent way the regulators can help the banks and help consumers establish fair practices across the board. Especially when you're looking at the phenomenon of prepaid cards, for example. There are some prepaid cards offered by, say, MetaBank that are attaching a loan product that functions very similar to a payday loan. And it's very disturbing for us to see this looking at how they can pry an extra $10 per paycheck out of people that just have a very small paycheck being loaded onto these cards in the first place. But I think a more explicit understanding of what fair small loans would be very beneficial.
Thank you. Mr. Tesdell?
I'll just make one comment, which I think that this is a great opportunity to use CRA in a way that we've just gone through this whole process with financial regulatory reform of, what we're going to permit and not permit. And I think there's one question is, are certain kinds of loans going to be permitted? Another question is, do you get CRA credit for making those kinds of loans or providing those kinds of products? And I think the CRA hurdle should be much higher than the is it permitted kind of hurdle. And it's a terrific opportunity for you folks, I think, to really think through what kinds of products are really responsive to the needs of low-income communities.
Thank you. Ms. Fiddler?
In light of the few banking institutions located on reservation, within reservation boundaries, I would say that the biggest thing and the best thing we have going for us is the native CDFI movement. So banks that are able to work or move into reservation or other definitions of native community could be encouraged to get points to work with the CDFIs. I'm sorry I come from this place that is going to promote that, but it's the community banks in our on our reservations that are actually moving money, getting access to the innovative products, and now we're developing the relationships with mainstream banks, although they don't invest in us either because we're not in the footprint. But it's so important that banks that are looking to perform within those areas and regions or come up with new products work with the community development financial institutions, because we can help coach, guide, and often deliver and pipeline up a test customer that finally moves up into good credit worthiness and that kind of thing. Thanks.
Thank you.
I would think about it again in a number of different pieces. So the consumer protection piece and what role CRA should play, I think fortunately the CFPB maybe clarifies this a little bit and allows that mechanism to ban or deal with certain products or come up with vanilla products, whatever it is, and so take that burden off of CRA, which it has tried to do at times, but I think better handled in its own sphere. I also think that going beyond credit to savings and transaction, I think is really important. I think we think about stabilizing, revitalizing communities. It's all about, it's not just about credit, it's about health and safety and jobs, and I think savings and accounts and transaction accounts checking are important. The important thing, once you decide if you think that's a public good, is whether banks should be cross-subsidizing this. So if the product makes money and it can be done mass market, hopefully they're doing it. Maybe they're not. I know lots of some examples. In the 90s, we learned how to make mortgage loans much more sensibly to low and moderate income communities, and in my opinion, that worked very well, separate from the toxic stuff that developed in 2000. So the dialogue is important, and there may be areas where banks could do things that they didn't realize they could. But to the extent it requires a cross-subsidy, then you got to think about what are the incentives, what are the rewards and sanctions that you want to put in place here and are appropriate in CRA. You have very limited room, I think, within the law now to do that. And maybe, like we'll skip to what seems different, low-income housing tax credits and new market tax credits, the government ought to get directly involved in the subsidizing of these products and provide, make these products so that they can help the community but also make good business sense for banks.
Thank you.
Okay. You're done. Okay. I have several questions. We'll see how many I can get to. I'd like to ask a question that is related somewhat to Mr. Willis's testimony, the written testimony, and something he mentioned today. So I am sensitive to the fact that a lot of times the CRA evaluations that come out, especially when you're talking about the larger banks, are very dated. It's true, by the time you roll up all those assessment areas and you get the information out, it's, you know, a year old, many times longer than a year old data, and that's a problem. So in the meantime, though, what I've heard, not just today, but at the other hearings we've had, are a lot of very good recommendations about additional things we need to look at, new ways of looking at things, which frankly are more complicated even than the ways we look at things now. And one of those was brought up by Gail today, which is the qualitative versus quantitative, which I think is a very good point but you have to admit that it's a lot faster to count loans than it is to get into the quality of those loans. So I'm trying to reconcile all this. While we have all these suggestions about all these additional factors we should be looking at the same time, we have a concern about, by the time we look at all that, the information's already dated and we need to somehow streamline this process and try to get things to be more timely. So any suggestions you might have as to how we reconcile all this, I think would be very helpful. And if you want, Mark, I can start with you, and I'd like to hear what others have to say about that.
Yeah. You've highlighted very clearly, Sandra, the dilemma here, or the trade-offs, potentially. One idea which probably not fully thought through, is some more, for at least the largest banks, some more idea of continuous exam. And it would have two things. One is they could get more regular feedback if something is not making sense, and the bank can then incorporate what change in direction they need to take in their business plans in a much more rapid fashion. And my idea of annual public discussion when the new data comes out, I think is also important, because I think public participation is important to the CRA process, and they need more current information. So I think that could also help deal with some of the issues of these sort of outdated PEs. Another advantage of the continuous, in my mind, is one thing that's a little strange, to be honest, about exams is that when the exam comes, excuse me, these examiners fly in from all over the country. They may or may not know the bank or the local communities. They have to learn that as part of the process. And inherent in my notion about something more continuous is where the examiners are also know the community. As people have talked here and mentioned, I know in other hearings, how well a bank's doing. Part of the way to evaluate that is to understand what's going on in the community and get feedback from the community. You know, who the community is and how to assess that. As you point out, all that, those are tough things, but I think there needs to be some more continuity in that than we probably get in this every 3 or 4 years, flying in a group of people who suddenly have to figure all this out and then write this up. There's got to be some ways to make that process a little bit easier. And as I mentioned in my testimony, I would say I think more examiner training and more examiner empowerment, I think, is really important for the examiners to be able to make those assessments on the ground.
Gail?
Sure. I think you raise a fair question, but if we have a choice between fast, poor, incomplete information and slow, good quality information that will help to shape the decisions banks and communities make going forward, I think we have to choose slow and more complete information. I like the idea that just like large institutions have on-site examiners for safety and standards, they might have an on-site CRA examiner. I kind of light bulb went off when the gentleman was speaking. But who knows if that will ever happen. Another way to address the currency of information problem, I mean, we all have this problem everywhere in the world. You know, at Consumer Reports we have it. Information is out of date almost the moment that you receive it, no matter what it is and when you receive it, is to make that information publicly available in a database with a comments page for the bank. If the bank is doing something newer and better since the ratings and the evaluation, they're going to want to put that up. And if you see a rating with out-of-date information, evaluation with out-of-date information, and there's no update, that might tell the public nothing's really changed. So that's another way to partially address the slowness issue.
Yeah,
one way maybe to think of this is to engage in sort of a business planning process rather than seeing this as a discontinuous periodic exam. That's the way banks, that's the way businesses work. They create business plans and they carry through those business plans. And if the regulator is sort of involved in that process, maybe on a continuous basis, the business plan's been blessed. The 4-year project to do a particular thing in a community has been agreed upon, and in subsequent exams, then you don't have to sort of rethink all that. There's the business plan; it's in place. The regulators have blessed it, and it's a matter of carrying it forward.
Yeah, I mean, I would just say that I'm not convinced that there must be a trade-off between those two activities, but it really it harkens back to some things that I saw you at the HMDA hearings in San Francisco a couple of weeks ago. If you want more data, must it be slowed down? How do you reconcile those two things? How much more leeway should someone have? It's a very legitimate question, and if there must be a trade-off, I would agree with Gail that it's more important to capture the data that's going to represent the full range of someone's lending activity. But I'm not convinced at the same time that there must be a trade-off. There's plenty of ways that technologically we can make things move smoother, and Mr. Willis's comments about a more continuous exam is one way in which we could do it.
I would just add getting feedback from tribal leadership and getting good, accurate data. This is, again, reservation challenges for distressed community definitions that whatever in South Dakota we have a 4.5% unemployment rate, but on the reservations it's closer to 50 to 70%. So if there was a priority placed on the distressed communities in America, because I'm also speaking from the perspective that of the poorest counties in the country, 6 of them are in South Dakota, and there are reservations. So I think that there's got to be some push on, and I know Appalachia and other rural places have the same challenge. I think there has to be a priority in looking at the most distress that we have, the economic conditions, and coming to understand them, especially from the Native perspective, getting tribal leadership involved to help make some determinations, and then go in and look at performance, the business planning process. What are the goals? How do we plan to alleviate? But take it, from a logical perspective of setting goals and then meeting those and evaluating that way.
Okay, quick, because I want to ask another question.
Just one other quick point, that if there's a way for the central research capacity, analysis capacity of the Fed to be able to do some of the sort of big picture work that then can be fed into the individual examiners, I think that would be helpful for the examiners and improve the product.
So you must have been reading my mind, because my next question actually was, in several of the previous hearings, we heard a lot of discussion about needs assessments and the importance of doing good ones, and that a lot of them aren't so great, and the banks don't always do a great job of this, frankly. And there was some discussion about whether the regulators should be doing the needs assessment work and kind of take the banks off the hook for this, but do a more thorough kind of economic analysis of the different areas. And as you were talking, your last comments, but also, Tanya, what you were talking about in terms of Native communities. So I was wondering, I wanted to get some indication from you as to what you thought about needs assessments and who should be doing them. Should the banks still be held responsible? Should the regulators be doing this kind of assessment? Who should be doing them?
I'm going to pipe in and just say regulators versus the banks, because my local community banks, and I love them very much, but they'll protect their information or protect their perspective. They can't be as objective as they need to be to continue to deliver high interest rate products or whatever. So not that I want to shoot them in the foot, but it should not be them in rural, remote areas or Indian reservations.
One problem with the current system where it relies on the banks through their performance, what is it? Huh? Yeah, performance context, thank you. I was going to think, right, performance evaluation. Context is that until the exam is over, you don't know whether the examiner is going to accept that. So part of the issue is certainty, and as Kerwin pointed out, there's business plans, there's all processes has to be built into. So I think there is a huge advantage of the regulators playing a role here, and collectively, so that everyone doesn't, each of them don't have to go to community groups themselves to get that input. It would then, as I said, give more clarity and predictability here. So.
I want to agree and disagree. Mostly disagree, but I do agree with Ms. Fiddler's point that there are some areas that are so important we can't leave behind, and certainly high unemployment areas fall in that list. The regulators could say very low-income areas, distressed areas, high unemployment areas. We are going to ask you in your exam what you did in these areas, so get ready to tell us. And that's not exactly the full needs assessment. It doesn't replace the performance context. I think it's important to hold the banks to the obligation to actually know the communities that we're asking them to serve under CRA. And if that piece has already become a little too formalized and a little too check the box, we had meetings, and if it becomes even less of the bank's responsibility, we lose that opportunity for the light bulb to go off when I was in a room once where a banker finally realized for the first time that a single room occupancy hotel should be underwritten as housing and not as a hotel with a high vacancy rate. And that was 20 years ago, but that was a breakthrough at the time, and that became a very successful piece of business for that bank. Those light bulbs can't go off unless people get to know each other, and the needs assessment is part of that.
Yeah, no, I'm done.
Okay. We have a bit more time, so we may get to come around for some further questions. But I would follow up on that thought, I guess. There was a comment made, I think, by you, Gail, about further to the thought you just expressed about kind of a head-banging element to all of this, that you really need people to get in there and bang some heads to figure out what needs doing. And another comment was made maybe by Mr. Willis about understanding the local context, and I mean various people have kind of echoed that thought. But if you look at some kind of regulator-based assessment, national thought process of kind of measuring and monitoring and laying out some strategies, that seems to get you pretty far away from the really understanding the local context, really being inside the local community, and that kind of head-banging thought. And is there some way to reconcile those thoughts of achieving meaningful direction to the process, but also making sure that things are happening where the rubber meets the road?
I think it's going to be very hard to do, but the signals that you send as regulators that we are looking for actual products, not just pilots. We're looking for things that actually there's take-up, real marketing within the bank and real take-up by the users. It's not sitting on a shelf somewhere. It's a business product, not a product to make the regulators happy. I think that will help. I do think that you can say, here are our expectations, but that you also need to be saying to the bank, I want to see where's the new product, or where's the different delivery system, channel, or marketing effect for the existing product that's actually making it work for people who weren't using it before. Because it's getting harder to bang heads together. The person who makes the decision is in Charlotte, or is in New York, or is somewhere other than where the people are who have the needs. And so if CRA can be satisfied by the person in the bank who wears the CRA hat going around holding a lot of meetings, that's not going to get us anywhere. And it's not going to open the bank up to these business opportunities. It's not going to help low and moderate income communities the way that CRA could help.
Yeah, I mean, I'd add into that thought the sort of internet bank issue that you raised, Mr. Rideout, where, the service is provided in the ether, and yet you would like that bank to meet the needs of people that it's having only electronic contact with, kind of adds to the complexity.
Yeah, indeed it does. But we really think that there's a wonderful opportunity for regulators to play a role in how this changes. There's no real better moment than right now for regulators to demand more from banks. It's really an opportune time to rethink some of the rules that were not in place that allowed some of the catastrophic lending environment to take shape, and how to prevent that from happening in the future. But in general, we'd really welcome seeing each of you regulators adopting a much more active role than until recently we had been accustomed to seeing in many areas. And so we think it's a wonderful opportunity.
I don't know that it really has to be an either-or thing of whether the regulators do the assessment or the banks do the assessment. I think the banks shouldn't be off the hook. I think they need to do the assessment. But you, as regulators doing a intelligent, involved job, need to do your own assessment. And there's also, I think, some sort of division of labor here. So, for example, to take an example of my field in community development venture capital, I think it would be terrific for the bank regulators to do an overall study about the availability of patient equity capital for small business development and job creation in the United States. Individual banks shouldn't have to replicate that for themselves. On the other hand, when it comes to the exact strategy and how to make the investment and how to structure the funds and that sort of thing, a Goldman Sachs or a J.P. Morgan Chase is very well placed to do the head banging to work all that out. So it's sort of intelligent engagement, I think, between the regulators and the banks and the community organizations, and we would be very happy and excited to take part in that kind of assessment.
Ms. Fiddler, or
Just more of the same, engaging with community organizations and leadership, the tribal leadership that we have in place, all of it coming together. So otherwise, no comment.
I reemphasize or agree with what Kerwin said here. It's a both and. I don't think it's an either or situation. With regard to headbanging, an interesting term, not one that always promotes smiles, but serious conversation between people is really important, where they're listening to each other, learning from each other. And I think part of the 95 reform in moving from process to, I say production, performance, we lost something there. There is something about process. There is something about making sure that the right people are talking to each other. And if somebody's in Charlotte, well, maybe you ought to look and see whether the person in Charlotte, went to Cleveland to meet with a group. I think there's some process elements under what we all call qualitative factors that ought to come back and have more weight and more significance in the examination process.
we are running a bit ahead of time. Does anyone else have a burning question on their list that they'd like to?
I absolutely do.
All right.
Great. Which
burn on.
I will. Actually, I have a couple of them, but I'll stick with one. Foreclosure prevention. A couple of panelists mentioned CRA credit recognition. I'll let you use the appropriate term for foreclosure prevention efforts on the part of institutions. I'll open it up to anybody who would like to expand on their thoughts.
Well, clearly there's a need now. It's a little tricky because if you cause the problem, should you now get some credit for solving it? But we're here. We need to solve these problems. I would look at whether the financial institution is actually achieving the ultimate goal of either keeping that family in the house or getting that house back into home ownership in another way. So I know in Cleveland, the Wynn folks asked you to give specific credit for donation of REO property. I think that's a very sensible, a little piece, but a sensible piece. On the modification and foreclosure prevention, we need effective programs, and we're not getting them so far. We're not getting enough of them so far.
How can we give credit for them is really the question.
I think you give credit for them depending on whether the loan is being done. It might be under the lending test. It might be a service test. It depends on what the outcome is. But I think you can and should give credit for performance which is better than the industry average or which meets some higher standard that actually results in people remaining in their homes with loans that they can pay going forward. And that's a big challenge.
Yes, it is.
I would add, too, that one thing you could do also is allow modifications to count for CRA lending and community development loans. I mean, right now, they don't because they're changes to an existing loan rather than a new loan, but you can incorporate that to give credit where credit is due to those lenders that are modifying in a way that keeps people in their homes.
Okay. Anybody else?
I would comment on it. I think the idea of keeping, again, as I said before, CRA up to date with recent market conditions, this is an excellent example, and I hope you can do something fast here. Unfortunately, we're already a couple of years into the crisis, but it also points out the fundamental problems that you need to deal with, and I think why you're holding these hearings, which is if stabilization efforts come under as community development loans or community development services, they don't get enough credit. So even you go into all this effort to make sure that it gets credit within CRA, it's getting credit in the things that I think are not being valued enough. And so, you know, I know if you heard about community development tests, we could talk more about that. So I think that part is, you know, really fundamental here to change the rules under which the way examinations proceed. And you know, one way to think about the value of whatever the efforts are is if the bank is doing something that is selling to a not-for-profit for less than what would be the market value. I think there are ways to do that without rewarding them for, or getting into, I shouldn't much prefer this, without getting into the issue of who created this in the first place. Right now we need to do things dramatically, I think, to help our communities and look for what the bank would be doing relative to what the market solution might be.
Thank you.
You mentioned this issue of community development test for large institutions, and would you expand on that? I mean, that's an issue that I think we'd like to explore.
Well, to me, and we probably could spend a whole session on exactly what CRA is about or was the intention, but to me it was about stabilizing and revitalizing communities. And in that regard, community development activities, community development lending through to CDFIs, particularly for affordable housing, construction loans, that's really critical to rebuilding, stabilizing and revitalizing communities. Controversially, grants, which move over into patient capital, those things should get a lot of attention. I think they are making a real marginal impact. They're not just doing something that banks or other financial institutions might be doing, but it's something that is having an incremental impact on the community. And as you know, those things get very small relative weight in the investment test. So,
do you have any suggestions on what the relative weightings should be if there were to be a community development test for large institutions?
I'm not sure I'm ready to say a ratio. I would just definitely say that I would give them separate prominence from the rest of investments so they don't get lost in that number. And community development services, you know, counseling or foreclosure prevention, these are really important issues. But quite honestly, in the existing exam, they get almost no credit. And so if you want CRA to have an impact on this particular issue, you've got to give them more. And I think the opportunity to do that in a community development test is a lot better than the way they're kind of broken up now into pieces. And they are, in some ways, interchangeable or mutually supporting, and so should be looked at as a group.
One question. I was trained as an engineer, so I tend to think sometimes about these systems and how they work. And it seems to me there's a tendency to keep adding pieces, but the notion of updating, streamlining is also one of trying to make the model work better. And so if we just keep adding tests and factors and regions and models and assessments and the rest, the machinery kind of gets heavier and heavier, and you know it gets harder to keep it working and kind of well oiled. And I wonder. I like this, the notion of the folks at interest having sort of a meeting to think about how to make some of these trade-offs, I think is quite an interesting idea. But in this concept of updating and streamlining, are there things that go away as things that are added, or are there things that morph into new models and new measures in lieu of what was there before, because it is a world in which someone has an interest in each element of the test, and I'm just wondering whether there, in this notion of updating, streamlining, there are some things that would change or would actually fall away as we move to a newer model.
Is there hope that things will fall away as if CRA actually does what it should do. Products are developed that the bank, that are sustainable for the bank as well as for the customer. And if they're sustainable enough, we have to see other banks coming in. I mean, there is some point at which people start to compete because they finally realize there's money to be made on a low and moderate income customer. And if we get to that point where everybody's doing it, where it's not patient capital, it's just a regular old plain loan made to someone in low and moderate income, maybe we don't need to count that anymore. Maybe we take that one off the list. When that product is fully integrated in the bank and has sort of graduated to be equal with the rest of the banking products, it's dangerous to take things off sooner than that because we could lose the momentum. But that's what we hope for.
Yeah, I think it's always important to keep in mind what's become outmoded or irrelevant. But when you're looking at, say, for example, what the original purpose of the CRA was intended to address, is there still redlining? Of course there is. Is there still urban decay? Absolutely. But more recently, we're seeing a more syndrome in this foreclosure crisis of suburban ghost towns where people in great communities. And that was wholly unanticipated when CRA was initiated. But so I think we ought to be cognizant of what can be taken away, but I think the much more salient problem is what's been added that we must continue to add, because the list of problems has not diminished.
A couple of thoughts. One, just this, I think this concept of continuous business planning streamlines things for everyone. You know, you sort of look at it once, it's set, it's blessed, and you go forward then carrying out your business plan rather than sort of having to marshal your evidence every year. And second, I think it'd be interesting to look at the idea of specialization, that not every bank has to do everything. Not every bank has to be, sort of examined equally on everything. And, if a bank is really good at doing a particular thing, then maybe another bank is the one that fills in someplace else. I think that puts a little bit more onus on you in the Sandy, your background research, whatever you're going to do. Then you're going to have to sort of connect the dots among the various banks and saying, overall, are capital markets for low-income people and communities being served, not necessarily that every single bank is doing all the serving.
Yeah, I share your concern, and that's. I don't think I have anything to say specifically to subtract, but I think the adding on here definitely risks. I think the ability of regulators to do the job that they need to do, and making something way too complicated, and we've talked about that. But let me just come back to the other notion. I think in a world where there is more continuous updating of the regs, where this becomes a regular process, things can be added and subtracted without everybody sitting in the room worried about, if I let this go and there is a financial crisis again in 10 years, I'm going to want to make sure it's there. So I better not let up here. And I just think that now there's just, because the moves are so separated, and I think people are fearful of losing forever something that seemed important and might be important again, that we've created a system here that is much harder to subtract things from, and could be easier if, well, we may do that for a few years. If it comes back, we're perfectly prepared to be able to add that back in. So I think this idea of a more continuous updating of the regulations also could help here a lot.
Yeah, I mean, if the notion that has been suggested of kind of a menu of things that are expected to be done within a plan is the thought, and not that everyone has to hit every point
That's also
in
true.
every feature, I mean, that may sort of square that circle to some extent. Do we have any?
Yeah, I just want to follow up on that just a little bit. In concept, I think this idea of continually updating the regulation is a good one. But I'm just wondering, practically speaking, considering we have APA requirements and comment periods and all that, how realistic it is. And one of the things, and I think this also gets to the thing, some of the things you were just talking about, is in addition to trying to stay current, one of the things about CRA that I have to admit that has always bothered me, and I'm speaking for myself now, not the Fed, is when we get those phone calls, which we do all the time, saying that, somebody has a really good project, but the bank won't do it unless they know for sure they're going to get CRA credit for it. And that, I have to say that when those phone calls make me crazy. It's like, how do we address this concept? And I was going to ask the bankers this question. It's like, if there's a good project on the table, it's good for the community, it's not going to cost, it's not going to lose the bank money. How do we get away from this thing of, I'm not going to do it unless you, regulator, promise me that I'm going to get X number of points of CRA credit for it? Like, how do we get away from that? Do you guys have any ideas?
That's a tough one, but one thing is you can give them credit for being first, or for doing it before you have seen it and approved it. That might help a little bit. I do like this idea, not so much of continuous update of the regulation because of the challenges you mentioned, but that the regulatory process should encourage banks to be continuously updating their CRA business plans. They should have a CRA business plan, whether it's a strategic plan option or just an internal business plan, and they ought to be updating it. I mean, bankers don't wait around for 3 years to develop a new product for any other type of customer, and they shouldn't be doing that for low and moderate income customers either, because they'd be out of date, they'd lose the business. For any other type of customer, those products can be continually updated. We need that same kind of business focus on how we're going to get, keep, and make money on the low-income and moderate-income customer. And the alternative sector is doing it. They're not doing it in a way that we think is useful or that builds family stability, but they're certainly doing it. And there has to be room between those pricing models and banks not being there at all to come in, make a profit, and still serve low and moderate income communities in a way that enhances family stability for those communities, economic stability.
As a former banker, Mr. Willis.
I'm not going to answer the question. I don't think I'll leave it to the bankers, but I will say I am equally frustrated when either other parts of the bank would call or community people would come in and say, well, let's do them separate. People come in, I want a CRA loan. I'd say, we don't have CRA loans. We have good loans. So part of your frustration here is what really is the conversation that's behind there. And when other parts of the bank would come and say, can we get CRA credit here? That's how I'll get it approved. I would say, I'm not going down that road, because if you can't get it approved as a business proposition, then there's something wrong here. And CRA should not be the excuse for somebody to do something that they're not otherwise comfortable with. So it's hard for you as a regulator, but it was a little easier for me. You need to get behind the question. Why are they asking the question in that way? Is it just an excuse to not do it, or what are they really trying to accomplish? So I'll leave it to you, the bankers, to tell you, give you more insight on that.
In thinking about this notion of continuously updating CRA, I'm sort of looking at some of our staff people here who are already assigned to one of the 75 task groups we have to implement the Dodd-Frank bill, and adding a continuous process on top of that might trigger mass suicide. Or
retirement.
That's right, or retirement for those of us in that range. But with that happy thought in mind, I'd like to thank all the witnesses for their thoughtful remarks. We will take a break for about just under 20 minutes. We ask you to return promptly because we will begin promptly at 11 and would like to have the witnesses in their seats at 10:55 so that we can start on time. Thank you very much.
Thank you.